It all comes back to the DNA. The firms that know who they are will know who to be. You can learn a lot about an investment firm by listening to what they say. Alco's Mainstream's AGM Originals, The DNA, Capturing Culture, is dedicated to capturing the DNA of a firm by listening to what they say. The first season of The DNA stars EQT, a global investment firm started in Stockholm in 1994 that has over 270 billion euros in AUM. I sat down for conversations with 9 EQT executives in Stockholm this past summer at their annual investor meeting. Each executive came from different parts of the firm and different parts of the world. Each had fascinating backgrounds and stories about how they ended up in private markets and working to build EQT. But there was a single through line threaded throughout all the discussions: the consistency and frequency that each executive talked about the firm's mission, vision, culture, and values. Episode 2 of Season 1 of The DNA stars Salata, Chairperson, EQT Asia. Jean, welcome to the show.
Michael, great to be here.
No, thank you for having me here in your offices. So much to talk about in terms of the business you've built, how you've thought about integrating with EQT, everything that's happening in Asia. First, I want to start with your background, though. You have a fascinating background. You ended up in Asia very early, so I'd love to hear the how and the why behind that.
I guess I've always felt a little bit like an outsider generally throughout my life, having grown up, started my life in South America and Chile, and then moved to the U.S. when I was 5 or 6 years old, didn't speak any English, arrived in Erie, Pennsylvania, small town in Pennsylvania, and saw snow for the first time in my life, and kind of started life there. And then one of my first jobs as a newspaper delivery boy, I thought, wow, you can actually make money when you're an 11-year-old kid. You can make $20 a month delivering newspapers. This is amazing. And then kind of just always felt a little bit different than everyone else in school and in my classes and things. But anyway, I worked hard at school and got into UPenn, and went to Wharton. And then when I was at school, I was always just, I guess, naturally interested in international business, and I studied international business at Wharton as an undergraduate. And then when I graduated, I went to work for Bain & Company, the consulting firm, but I had met my girlfriend in college who was from Hong Kong. And this was pre-internet days, pre-email days. And the only way to stay in touch was either to write letters or to make very expensive phone calls. I mean, we're talking something like, she gone to China to study Chinese. So calling from Boston to China in the 1980s cost something like $10 a minute. Which is very unaffordable. And so I had to figure out how I could keep this relationship going. And I managed to convince someone on the Bain team. They had one client in Hong Kong that had been staffed out of the London office, and I managed to get myself onto that case. So I went to Hong Kong in 1989, it's 37 years ago, initially for a 6-month assignment, and basically never left, never came back.
I want to first ask, what do you think being an outsider, as you said, has helped you from a business and investing perspective?
Yeah, it's an interesting question. I think, for example, when I remember being in the U.S. as a young boy and thinking about how things were done in Chile versus the way they were done there. And we would take some trips back when I was still quite young to visit my family in Chile, and I had to take time off school to do it. So I would do these projects where I would do a photography project, and I was sort of very intrigued by the idea of like, this is the way that, say, like telephones in Chile look, and I would take a picture of that, and I'd come back and or this is the kind of streetcars that there are in Chile, or this is the sort of the way that the kind of food that people eat, and so I'd come back, and even as a sort of like 5th or 6th grader, I would give these slideshows. I'm talking about the 35 millimeter slides of things in that country versus in the U.S. And it's sort of making these comparisons. I always felt like I was a little bit on the outside looking in. And so when I went to Asia, I remember thinking about, what is so unique about this place in Hong Kong and what's going on in Asia versus what I'm familiar with now in the US. And I was trying to draw some comparisons and contrasts. And that's when I picked up on what's going on in private equity and venture capital in those days. And it was completely almost unheard of in Hong Kong and Asia. And so I was sort of attuned to that, thinking there's a gap here and there's some sort of a gap in the market and there could be an opportunity. So I better stay alert and see what happens.
So if we take that leitmotif of you taking pictures
Right.
and looking at things in a different way and trying to compare and contrast,
Right.
let's take that and do that with the Asian private equity market versus some of the more developed markets. What would, if you were taking pictures today, just as you were as a kid,
Right.
what would that look like in Asian market versus US or European markets?
I think one of the key differences is that it's just less developed. And so the markets are more inefficient. We like to talk about the idea that there's more structural alpha in Asia than there is in the US and Europe in terms of the markets being less developed, less efficient. Where does this alpha come from? It comes from a couple of different areas. I think number one, we're operating in an environment with a lot more growth, some structural growth drivers like middle class consumer-led growth in healthcare, in consumption of services, things like migration of cloud to cloud of software services relatively early in the adoption phase. Even an economy like Japan, which is a fairly advanced economy, the level of cloud adoption or cloud migration or cloud-based software is probably something like, I'd say, 10 years behind the US still. Most people are still operating client server on-prem because they think it's safer, because they're used to it. And so there is this sort of, you can see where things have gone in the US and in Europe, and they're likely to head that way eventually. So there's this sort of a trend line that you can try to follow, which creates a roadmap. I think the second factor is just the relative supply and demand of capital in the region versus the opportunity set. And you take a market like Japan right now, they're just starting to experience the levels of shareholder activism that you've had in developed markets historically. And a lot of these issues that have been dealt with over the years in the West and are still playing out are just getting started. We're really just scratching the surface in Asia as these trends start to play out. And I think the other interesting contrast is that the sources of liquidity and the types of liquidity that we're able to access in terms of our exit strategy are a lot less correlated than people imagine in the way that we access the markets for liquidity. Like take, for example, the Indian stock market. The Indian stock market, it's a $5 trillion market, which is about the same size as, say, Hong Kong, only slightly smaller than Japan. And about the same size as the UK, actually. It's actually slightly larger than the UK. So we have a very large stock market here in a country that's only relatively recently started the idea of shareholder ownership across retail investors. Until recently, it was a market that was primarily invested in by foreign hedge funds and foreign fund managers. That created a very volatile and somewhat illiquid environment. But now you have domestic savings pools, insurance companies, pension funds, and also these sort of 401k equivalents in India, which are called SIPs or structured investment plans, where you take, say, $100 out of your pay every month automatically, deducted. It goes into a mutual fund. That mutual fund's invests in the stock market. That is new inflows into the stock market, creating all this liquidity now in domestic savings pools. So a lot of these sort of underlying trends are pretty different than what you have in the developed markets. And now we're bringing sort of the toolkit of private equity from the West and from the developed markets to Asia.
I think that's a great way to tie it all together in terms of what the Asian opportunity looks like now. I kind of wanted to create a snapshot of what today looks like,
Right.
so we could roll back the tape and go back to
Right.
as you built Bearings and evolved the firm in a market that was also evolving to the point that it is today. And then we'll get to the opportunity going forward, because I think it's a really interesting discussion to have. But when you started BPEA in '97, what did you see as the opportunity set? And what was, in your mind, it was obviously different than the US or European private equity markets. What did the risks look like to you?
When we started off, it was really about, in those days, it was about investing in privately owned businesses that were eventually going to be taken public, primarily in those days in Hong Kong. So it was, and a lot of those companies were Chinese companies, some Singapore, some Chinese companies, that basically buying in minority stakes. So we had a founder who had a business, like a manufacturing business, and he was making products, exporting to the US markets or European markets, you could buy a stake in his business. And by the way, in those days, you kind of had to explain to them what private equity is. They had no idea that, oh, you mean I can sell a small share in my company to you, and then what happens? And you're going to help me go public? And so it was a minority strategy, a kind of a pre-IPO strategy, where you take a stake, and then a couple of years later, the company goes public, and the company's grown, and the multiple expands, and you make money. That strategy worked reasonably well, but then we had a couple of things happen. We had the tech bubble in 2000, and then we also then had the GFC in 2007. And we realized, first of all, it was A, too opportunistic, not focused enough, and B, the minority strategy has some drawbacks to it related to governance, related to your ability to get liquidity. And so we evolved that strategy to become more focused eventually on buyouts, and now we're 100% focused on buyouts. Then we started to also become more thematic in top-down thinking about where we wanted to invest, in the sectors that we wanted to be exposed to. And that also, I think, created more of a tailwind in the kind of underlying growth of the businesses that we're investing in overall.
What do you think starting out with the minority strategy do for you in terms of the mindset of how you were as a firm and investor?
Yeah, I think it was a critical part of the way we formed our culture and our collaborative sort of approach to doing business, which I think in Asia, it is different than doing business in the U.S. The markets here are more, I'd say, relationship based. There's a culture. Each country is very different. You're talking about China or India or Southeast Asia or Australia or Japan. Each one is quite different, but there's some common threads, and I think building a sort of chemistry with founders and management teams is really critical in building trust in order to get into a situation where you can negotiate a transaction. The idea of just buying a company outright and calling all the shots and sort of forcing people to do things through the legal system or through, a hard, sort of a tough approach, it can work in some cases, but that's generally not been our approach. So I think that formed our initial ways of thinking about how we partner with companies and management teams.
So in Asia, do you feel that there's a different skill set that's required to be a good investor than there are in other parts of the world?
I think it is a market that requires an understanding of local customs and local culture and local ways of doing business. But I think overall, the business has evolved now to the point where I would say that much of what we do is similar to what happens in the rest of the world, but we have to apply our lens to it to adapt it to the local market conditions.
That's an interesting jumping off point, because locals with locals is
Right.
a core part of the DNA of EQT, also of BPEA. You thought a lot about building your firm and then ultimately becoming part of EQT. What did you see in EQT that said this is a great fit for the business and from a culture perspective?
Well, I think one of the things I've always tried to do is to kind of set a direction for our business and create a sense of forward motion towards that big objective. Most people are motivated by being part of something larger than themselves, including myself. In the back of my mind, I always was thinking, how do we build the deal-making machine that we have and the funds, fund one, fund two, fund three, how do we build a business out of that? But how do we actually create an enterprise out of this that's going to last? And so in order to do that, you need to institutionalize the business. I think the idea that you can create a diversified, large-scale regional business, that was the first step. And that took time. That took multiple decades, to get that right and to put the team in place and to have everybody working together, build a track record. Then, having done that, and then scaling up the business, then it's a question of how do you scale up the sizes of the funds and the deals so that it becomes a more meaningful platform. I started to realize that our industry is becoming more than just a partnership industry where a bunch of people get together and do deals, but they're starting to create asset management businesses out of this. Diversifying into more than a single fund or single asset class. And I realized that in order to do that, you need to sort of crystallize and create the equity value in the business as a building block. And one way to do that would be to bring in an outside shareholder. We considered going public at a certain point. And then it became obvious to me that the industry I wouldn't say obvious, but it became, I thought to myself that there's a trend here that is going to lead to industry consolidation for a couple of reasons. One is the bar of what's required to be successful in doing deals and in generating returns keeps getting higher and higher and higher in order to compete. But importantly also on the client side, our LPs, you could see the trends there, which was fewer, larger relationships. They didn't want to have 100 GPs managing 100 fund programs for them. They wanted to have 20 or 30 relationships that could do 3 times as much for them. And that's more efficient for them. And over time also, it started to be evident that the larger firms had certain advantages in terms of the kinds of returns and the sort of access to deals and the ability to deliver consistent outcomes over time and sort of institutionalizing their businesses through multiple generations of management teams. And there's going to be the big global firms that consolidate and have a broad offering. I think being in the middle is quite challenging. In my mind, it became very compelling to become part of a global business that either we do it ourselves to become global and large, which is going to be hard because the industry is developed already, or we become part of a bigger organization that already has achieved 80% of that and we can be the other 20%. And that's essentially what happened in bringing the two businesses together.
What's interesting is, yes, maybe they built 80% and you're the other 20%, but Asia is also such a growth area that maybe it's not 80-20, maybe especially on the go forward. So I'd love to talk about that. I know you reference structural alpha a bit. I'd love to unpack that because I think that's so pertinent to what's happening in today's world, how LPs should be thinking about where they direct their own capital.
Yeah.
So how do you think about the opportunity set in Asia today, and what does that look like going forward?
I think that there's at the moment we're seeing a rebalancing of capital out of the U.S. into Asia, into Europe for a variety of reasons, including geopolitical and political, but also just simply related to valuation and opportunities. I think within Asia, there is, on a go-forward basis, tremendous underpenetration of the opportunities in private equity because we have less capital at work in the marketplace, so that's capital. The pools of capital are still forming. The sort of capitalization, if you want to call it that, of the industry is still developing. Secondly, the penetration within the countries and sectors in terms of understanding the role that private equity plays. If you look at percentage of GDP, for example, of PE transactions, even in an economy like Japan, it's less than 1% of GDP versus, say, 2.5% or 3% in Europe and the US. We have about half the world's GDP in Asia, 60% of GDP growth. There's really no reason why a fund program in Asia should be any different in terms of the scale of the program versus the fund program in the US or Europe. And right now, fund sizes tend to be half the size they are in Europe and the US, so that implies a lot of room for growth in fund sizes.
Can additional capital support the types of returns that you want to deliver to investors in Asia?
Absolutely. I mean, we already, in our last fund, Fund 8, it's an $11 billion fund. We invested $11 billion of capital in the fund, but we also did $16 billion of co-investment alongside the fund. So we deployed $27 billion of capital over 3-4 years. And, for example, take privates. It's a segment of the market where you're essentially, this happened in the US over the last 20 years with a number of publicly traded companies reduced by something like 50% in the US, down from maybe 8 or 10,000 to something 4 or 5,000. That hasn't happened in Asia yet, and that's if you add it up, it's in the trillions of dollars of market cap of companies that could be delisted and made more efficient.
What will it take for that to happen? Is that companies understanding that it might be better to be in private markets, so they might want to stay private longer? Is that a change in mentality from a management team or investors?
Yeah, I think that it's happening already. You see basically people, you have CEOs, for example, that are running public companies and they get frustrated with the short-termism in the public markets where they are on this quarterly earnings clock and they have things that they think they should be doing to drive the business, to really drive value, but they're a little bit constrained by being a public company. So there's that. You've got conglomerates that exist in Asia that are, over years, have accumulated all sorts of different businesses, many of which are no longer core. they're starting to look at that again and say, do we need to be in 100 different subsidiaries and different businesses, or should we be focusing more on getting rid of some of these non-core assets? So I think all of that is happening, and we're very early in that development of that. And then on top of that, you have the family generational change issues, which is kind of like post-World War II in Asia, industrialization of the economies, founders that are now probably second generation, some third. But as you start to get into these more distributed ownership of originally family-owned businesses, they naturally end up selling those businesses to owners, to new owners.
Part of EQT's founding story is really around family business, the Wallenberg heritage.
Yeah.
How much do you think that culture and DNA resonates when you're partnering with family businesses in Asia?
Oh, it's hugely important. Since we merged with EQT, we've noticed a big difference in markets like, say, Japan and Korea, where when you talk about the Wallenberg heritage of EQT and the industrial mindset that we have, fifth generation, now sixth generation of Wallenbergs, and thinking long term, and really thinking about running businesses, not a kind of a financial operation, but more of a business building operation mindset, even though we are a private equity firm. But the fact that the Wallenbergs are the largest shareholders of EQT, it does make a big difference. And when people are thinking about if they're going to sell a subsidiary or sell even their whole company, they worry about their reputation as to who they're selling to, and want to make sure their employees are looked after properly, or that their business is going to go into good hands and it's not going to go off the rails once it's owned by a new owner. And I think being a responsible owner, which is the reputation that the EQT has and the Wallenbergs have, is a differentiator for us.
Where my mind goes with that is you referenced the growth opportunity in Asia.
Mm-hmm.
You think about the next 20, 30 years, that opportunity looks massive, just given demographic shifts.
Mm-hmm.
Look at a place like India. You talk about getting people invested in the stock market. I think it's 2 million or so new brokerage accounts in just India alone per month that are being added. So you think about the go forward, and there's a tremendous growth opportunity all around Asia and adding a growing middle class. How do you balance that rapid growth opportunity with thinking as a long-term investor? And maybe actually those things go really well together, because you can own these businesses for 15, 20 years, and there's going to be tremendous growth, probably more than in other markets.
Yeah, I think the growth in Asia, the runway is very, very long. And the way that we're approaching that is we have our large cap buyout fund, which is continuing to grow in size and continue to buy larger businesses that are compounding in size and value. But we also have a mid-market fund. We call it the Mid-Market Growth Fund. This is a $1.5 billion fund that we raised a few years ago that invests in mid-sized buyouts. And these tend to be much higher growth businesses that are smaller today, starting from a smaller base, but have that sort of high growth rate potential to continue to grow. And when you go and talk to a family or a founder or a corporate, you don't necessarily have to put them into one bucket. You can have a broad-based discussion about how you can be their partner in helping them to grow and expand their business. Is
the exit market there?
The exit market is a lot deeper than it used to be. We had the biggest exit year ever last year for our business in Asia. We had $13 billion of distributions in the first 5 months of this year. That's, I think, a testament to a few things. One is that we are in thematic, interesting businesses that people want to own. So one of our biggest exits was Nord Anglia Education, which is one of the largest privately owned education companies in the world. We just signed an exit on a company called AGS, which is a Southeast Asia-based tech services company that is in the healthcare technology space. It's extremely thematic, and there's a lot of work going on in this space to use AI to actually make that business to sort of turbocharge that business. And we had a very competitive field of buyers for that, which were mainly sponsors. In that case, they were all financial sponsors.
That's an interesting question, because when you lay out the Asia growth story, it feels like LP capital will flow there to a greater extent than it has, but also GPs and these large scale platforms that have great brands will look at this and say, we need to invest. They may not have been there as long in some cases. Do you think that will represent an interesting exit opportunity where some of these firms are later to the party in Asia and they'll be the ones who are buying businesses from firms who've been there?
Yeah, absolutely. That's a very important part of the ecosystem that's developing. And we didn't used to have that, but now we have that. So we have the global buyout firms coming to Asia. Many of them are already well established. They're buying assets from us. They're creating liquidity in the market. We sometimes buy assets from them as well. So I think having that healthy ecosystem is part of the maturation of our industry, which is, I think, a positive development for us.
What would you tell LPs about perceived risk versus actual risk in investing in Asia?
It is a complex region. There's volatility. I think we are structured to take on that volatility well and actually probably benefit from that. When you have these bouts of volatility, you can use it to buy assets at better valuations, or even buy assets that might not be available normally as a result of that volatility. But in order to address the region in a way that manages the risks and captures the alpha and the upside, you need to, number one, I think, have a diversified portfolio construction. But I think the regional diversified approach is the way to go. That deals with part of the issues around risk, is that you are distributed around the region. Number two, I do think that the buyout strategy and the evolution of that strategy to where it is today means that you have a lot less risk that you're taking in the portfolio. Being thematic is extremely important, not being too opportunistic and investing in all sorts of different businesses, but sticking to businesses that have good, strong, multi-decade kind of tailwinds behind them, but also you understand deeply and have a lot of experience and can bring your value creation playbook to. Having a strategy that is based not on just picking the right companies, but also value creation and demonstrating that you're doing that consistently is another way to manage risk.
I think that's a really interesting point when you think about risk, right? It's you've managed to mitigate risk, but also there's so much upside, perhaps more than in other regions, given the growth trajectory of the region.
It also, sorry to interrupt, but it also comes back to the alpha point, which is there is structural, we think there is alpha in Asia. In a developed market context, if you look at the returns between the public markets and the private markets, they're pretty similar. They're very strong. If you look at the private markets in Asia, we are delivering very similar returns to what our colleagues in the US and Europe do, but we're doing it without the public market beta. And so there's more of a buffer.
I think that's a great segue to the next question, which I'll ask through a slightly different lens, which is I want to ask about what you think is the most interesting and exciting aspect of investing in Asia today. But I want to ask it through the lens of an outsider. You've been an outsider, but you've also now been in Asia for a long period of time. What would you say to outsiders looking at Asia from your perspective, what the most exciting aspect of investing in Asia is today?
This is where a lot of the new growth and opportunity is going to be in the world. There's just still tremendous white space in so many industries, so many subsectors. It's also, to me personally, a pretty intellectually and kind of personally intriguing environment to be in, stimulating environment to be in, because you just are exposed to so many different cultures, different perspectives and ways of doing things.
How do you go about properly understanding and appreciating all the different cultures in the region?
Well, I think you have to have a very much like an open mind and a mindset of continuous learning and curiosity about everything that's going on around you. I've always been fascinated by learning and continuing to learn and experience new things and kind of the different approach to doing things. I love it when I get one of those moments where you either you read something or you talk something you just saw and you say, I never thought of it that way. And then you try to apply that insight into something else. Like you say, let me take that insight and apply it to investing or apply it to the way I raise my kids or, kind of the cross fertilization that happens when you're exposed to new ways of thinking, I think is fascinating.
What do you think has been the biggest learning you've had from all the time you spent there?
Wow. I would say that's probably humility of realizing that you don't know as much as you think you know. And it's important to really listen to people and before making decisions, to truly listen to different perspectives, and to just, I guess, be open to learning, continuous learning and listening to other people's views. I would say, though, that there's this other aspect to leadership and building a business that I talk about sometimes, which is worth mentioning, which is I think there's a difference between sort of confidence and certainty in the way that you, as a leader, lead an organization or create a business environment where you're trying to shape the direction. So I do think it's important to have confidence. So this idea of uncertainty or listening to others is important, but you need to, I think you need to have a direction, and you need to be confident that that's the right direction. And people, I think, take confidence from the idea that you're pointing in a direction that makes sense, that everybody believes in, that everybody wants to achieve. It doesn't mean that you have certainty that it's 100% right. And I think the difference between confidence and certainty is that element of, I think it's right, we're going to try very hard to do this, but it may not be right. And if it's not, let me know. Like, everyone pitch in and let's keep an open mind. Because if you kind of obstinate and say, okay, we're going to go this way, and I know I'm right, then that's when you make big mistakes. And I think that's where if you talk about my biggest learnings, it's having too much certainty or not enough, willingness to question or think through things, where that causes you to not realize that you're making a mistake, and that can compound itself if you're not open to course correcting that mistake.
I think that's such an illuminating window into how to think about culture. And you said something earlier, which I want to ask about as we wrap this up, which is, you talked about making sure people are motivated and having this continuous mindset of learning as part of that motivation. What motivates you?
Well, let me just address that first point about, I'll comment what motivates me, but the motivation point is really critical. And I'll tell you, when I was 23 years old at Bain & Company in my first job, my first year in the job, and I got my first annual review by my manager. And I was the kind of person that worked really hard, like tried super hard to excel in everything I did. And I really put my heart and soul into my work. And when I sat down at the end of the year, and this manager who was reviewing me sat down, and he took such care in the review and had actually noticed I felt like he really realized that I was trying hard and that I was working hard and doing my best. And there was recognition of that. I was so motivated by that. And, I think there was a bonus pool, and you sort of like, if you're in the main part of the pool, you got $2,000. If you were in this small part, you got $3,000. And I got the $3,000 bonus because I was, recognized as being one of the top performers. And I just remember, and to this day, I remember thinking to myself, I'm so glad that people are actually recognizing and realizing that I'm trying hard. And that stuck with me. And so as we were building the business, I made a point, and I continue to make a point to this day, of paying attention to people's efforts and sitting down. And I sit down with like 17 or 18 people who are my direct reports. We've reorganized a little bit, but until recently it was a lot of people. And I spend a lot of time with them, and I go over kind of how they're doing, what they're doing, what's going well, what's not going well. I think paying attention to people's development and career development is extremely motivating. And it's very important, I think, in building a business to recognize and pay attention to people's development and not just have it as a given that people are working their rear ends off for you, and they're just, it's like, they're not being recognized for that.
Do you think you can nurture intrinsic motivation?
Well, I think the intrinsic motivation, that comes kind of to what motivates me, comes from just curiosity and a desire, an intrinsic desire or love of what you do, an interest in what you do, like a fascination with what you do. And there has to be an element of that. I'm not, of course, not 100% of my job or anybody's job is going to be fascinating, but there has to be enough of what you do that you really enjoy, that it makes it interesting, that motivates you to be the best that you can be in that role.
I think that's such a great way to wrap up this conversation, because you started by talking about how when you were a kid, you'd go and take pictures, and as part of your school projects when you go back to Chile, and just fascinated by the culture and the people. You've done that as you've gone to Asia. You've done that as you've built BPEA and now EQT. So what a fantastic conversation.
Thank you, Michael. That was very, very, very good. I enjoyed that.
Likewise.
Thanks a lot.
Thank you for listening to this episode of The DNA, Capturing Culture. You can stream all the episodes on your YouTube channel. at altgoesmainstream AGM, or read about the episode at my Substack at altgoesmainstream.substack.com. And of course, special thank you to EQT and the executives that shared their stories and perspectives. Thanks a lot, and have a great day.